Jahangir Aziz as well, who's joining in. He's MD and Head Emerging Market Economics Research at JP Morgan. Jahangir, good to have you on board. Thank you for taking time out and joining in. And clearly, the budget being described as judicious, where prudence trumps populism, and how the government has really done the right thing. How would you describe the budget?
So look, on the headline numbers, we expected the budget deficit to be about 5.2 in a pre-budget preview of it. It surprised even us and delivered 5.1. So obviously, we have to laud the government in delivering a very strong consolidation. And in our view, given where India's growth is, and you could quibble with the numbers, with the 6% or 7%, FY24 and FY25, you are going to see these 6-7% growth numbers. This inflation is on track. It is not really where the RBI wants it to be, but it's getting there, largely because most of the disinflation is being driven by a normalization of. And if the Fed's, cuts somewhere between now and June, we have a June date, but the Fed starts cutting. That gives the RBI, ample space to start cutting rates and support the economy. So there was never really any need to provide macroeconomic support at this point in time. Instead, what was really needed was that they focus back on fiscal consolidation just to get, India's debt stock stabilizing around the 83-84%, which we think is going to happen, because even if you compare it to pre-pandemic levels, which was at 70%, you're about 15 percentage points higher stock of debt. So it was needed to start consolidating and consolidating early.
Jahangir, you think now, from what the finance ministry has done, the action is going to more move towards RBI? We already had, saw what the Fed indicated. You think now that pivot and the cycle turn of when the rate easing is going to begin is going to act as the next big trigger for both equity markets as well as bonds?
Yeah, I mean, look, the government has done its job, right? This was a 0.7% consolidation. And given, the track record of this particular team in North Block, they have actually delivered, year after year. It is not that, they have missed their target. So we can be pretty much sure that, unless something untoward happens in the global economy, we will get the 5.8% fiscal deficit done. It has actually brought down total gross borrowing. You add on to it that, with some persuasion, if you can get the state governments to start paring back from the, 3.1, 3.2% to, let's say, closer to 2.7, 2.8%, both of them together now creates the kind of fiscal space that the RBI would have needed if it was to go on a, significant easing cycle. And I think that what is holding the RBI back is simply that, the interest rate differentials with the Fed is still too low for them to do that without, raising concerns about financial stability. So my guess is that, look, the RBI will do a Fed. They are going to say that, enough amount of, progress has been done on inflation, but they still need to see some more data, and they still need to be some more convinced that we are on the right track, and that the government has provided them with this fiscal consolidation, a very credible policy framework within which they can start cutting rates. I don't think they're going to cut rates till the Fed actually does cut rates, but after that, yeah, you could see some reasonable, cuts in RBI's policy.
Quite interesting. Also have to talk about, Jahangir, what's happening within India equity markets. While we're rip-roaring and we're already looking at a fresh all-time high and, eyeing that once again, the fact of the matter is that foreign money has completely eluded India, right? All through 2023, and we're seeing that play out this year so far as well. Do you think purely because of our positioning vis-a-vis the rest of the world, 2024 makes a stronger case for more flows and concentrated ones at that towards emerging markets, and thereby India also benefiting?
Yeah. So that's what we are hoping to see. Obviously, in January, we did not get that kind of flows that we were expecting. And part of the reason was that, you had this exuberance in December where you did see actually significant amount of flows coming into emerging markets. not in Indian equities, but there was significant amount of emerging market flows coming in. But again, questions about whether or not when the Fed will start cutting rate. Again, with the March rate cut being pushed back, I think that also, pushes back this rate cut. You really need the Fed to start cutting rates, and you really need, the 10-year rate and the 2-year rate in the US to start sliding down to more normal levels. It is very, very hard to see people putting money in, risk assets outside of their comfort zone, i.e., getting over their home bias. When this cash was paying you about 4.5%, 5% not too long back, and your own equity market was, giving you a significant amount of upside. So I think that, you really require this interest rate differential to start narrowing. Once that happens, we do expect emerging market countries, including India, to see significant amount of portfolio flows, and flows will be returning. And again, what we should keep in mind is that even if you look at the entire, post-pandemic period, if we add up all the flows that have come into emerging markets, there haven't been very much. So people do not own emerging market assets very much. Ownership is very low. Positioning is very low. So I think once that trigger starts, I think you should not be surprised with significant flows coming in.
That seems to solve our problem. Jahangir, great having you on the show today. Thank you so much for taking the time out.
Sure.
Okay, let's move on.